Do you feel like you're working hard but still not seeing the financial progress you expect? What if I told you that certain mistakes are quietly draining your financial growth, and you might not even notice? If you're here to take control of your financial future and start building lasting wealth, you're in the right place. Today, we're going to dive into the top 8 income mistakes that could be slowing down your financial growth. These aren't always obvious, but they can significantly impact your long-term goals. Whether you're just beginning your financial journey or looking to elevate your current situation. Now, let's get started. 1. Failing to budget or track expenses. Have you ever reached the end of the month and wondered why your bank account is emptier than expected? This often comes down to not having a clear picture of where your money is going. Without a budget, it's easy to fall into the trap of spending on things that don't align with your financial goals. Whether it's the impulse buy at the store or the monthly subscription service you forgot about, these small expenses quickly add up. Before you know it, most of your income is gone, and you haven't put anything aside for savings or investments. This is where budgeting can transform your finances. Think of it as a roadmap that helps you avoid unnecessary purchases. You can use a simple rule like the 60-40 rule, which divides your income into 2 categories: 60% for living expenses and essentials, and the remaining 40% for savings, investments, and discretionary spending. By following this structure, you're taking charge of your money and prioritizing your long-term financial goals. Once you start tracking your expenses, you'll quickly notice how much more you can save and invest. Start creating a budget today and watch how it changes your financial habits moving forward. 2. Delaying retirement savings. How often do you tell yourself, "I'll start saving for retirement when I make more money"? If you're guilty of this, you're not alone, but delaying your retirement savings is a big mistake. Many people don't fully grasp how important time is when it comes to growing wealth. By procrastinating, you're missing out on compound interest, the key to building substantial wealth over time. Even if you can only set aside a small amount in the beginning, it's better than doing nothing. The earlier you start, the more time your money has to grow. A few years of delay can cost you thousands of dollars in missed compound growth. As time goes on, you'll see the effect of compound interest working in your favor. It's not about starting with a large amount. It's about starting early and letting your money grow over the long haul. So, if you haven't started saving for retirement yet, make today the day you begin. Open an IRA, contribute to your 401k, or simply start by setting aside a small percentage of your income each month. The earlier you start, the stronger your retirement savings will be. 3. Neglecting an emergency fund. Life is unpredictable. Unexpected expenses can arise at any moment. Whether the car repair, a medical emergency, or a sudden home repair, these unforeseen events can easily derail your financial progress. Without an emergency fund, you could end up relying on credit cards or tapping into your investments, which could lead to high-interest debt or lost growth opportunities. An emergency fund serves as your financial safety net. It's a cushion that allows you to navigate life's challenges without sacrificing your long-term goals. Experts recommend setting aside 3 to 6 months' worth of living expenses in a high-yield savings account. This way, when life throws a curveball, you won't need to dip into your investment accounts or go into debt to cover the costs. Building an emergency fund doesn't happen overnight, but even starting with small, consistent contributions can help you build a solid cushion. Think of it as your peace of mind. It ensures that no matter what life throws your way, you can continue on your path to financial freedom without having to make rash decisions. 4. Carrying high-interest debt. If you're only making the minimum payments on your credit cards, you're likely paying more in interest than you realize. High-interest debt, especially credit card debt, is one of the biggest roadblocks to financial success. The longer you carry that debt, the more interest you'll pay, and the harder it becomes to build wealth. The solution is simple. Prioritize paying off high-interest debt. Start by focusing on the debt with the highest interest rate, or try the debt snowball method, where you tackle the smallest debt first. Both approaches can help you get out of debt more quickly and efficiently. Once you've paid off your high-interest debt, you'll free up a significant amount of money each month, which can be redirected towards saving and investing. The longer you wait, the more you lose to interest charges. Pay off your debt first, and then watch your savings grow. 5. ignoring the impact of inflation. Inflation is a silent wealth killer. While keeping your money in a savings account may seem like a safe option, inflation can slowly erode its purchasing power. If your savings aren't growing faster than inflation, you're losing money over time. Even if your account balance remains the same, to outpace inflation, your investments need to work harder for you. Instead of letting your money sit idle in low-yield accounts, put into growth assets like stocks, real estate, or bonds. These assets appreciate over time and generate returns that beat inflation. Don't let your savings sit stagnant. Even if inflation is at a low rate, if your money is sitting in cash, you're losing ground. Make sure your money is working harder than inflation by investing in assets that appreciate over time. 6. Lack of investment diversification. Concentration risk can seriously jeopardize your wealth. Imagine putting all your money into a single tech stock or relying solely on one industry like energy. If that sector experiences a downturn, you could see a large chunk of your wealth disappear. To safeguard your financial future, it's essential to diversify your investments across multiple asset classes, such as stocks, bonds, real estate, and even commodities like gold. This strategy not only reduces the risk of heavy losses, but also allows you to tap into growth from different sectors. For example, while the stock market might experience volatility, real estate or bonds could still provide steady returns, offering you more stability. The key is to spread your investments across various areas, so that if one part of your portfolio suffers, the others can help buffer the impact. Diversification is your safety net and ensures long-term growth despite market fluctuations. 7. Underestimating taxes and fees. How much do you really pay in taxes and fees? If you're not mindful of your tax situation or the fees associated with your investments, they can quietly eat away at your returns. High taxes and excessive fees can erode your wealth over time, making it harder to reach your financial goals. Using tax advantage accounts like HSAs and IRAs for 401(k)s can help you keep more of your money. These accounts allow your money to grow tax-free or tax-deferred, which helps you save for the future while minimizing tax burdens. Additionally, watch out for high management fees on your investments. These fees can slowly reduce your returns, so it's essential to choose low-cost index funds or other investments with minimal fees. By optimizing your tax strategy and choosing investments with low fees, you'll keep more of your money working for you, accelerating your financial growth. 8. Being underinsured. Insurance isn't something people always think about, but having the right coverage can make or break your financial stability. Without proper insurance, a serious illness, accident, or unexpected loss could wipe out your savings and investments, setting you back years. Whether it's life insurance, health insurance, or disability insurance, each one serves as a safety net that protects your financial future. Life insurance can protect your loved ones. Disability insurance safeguards your income, and health insurance can prevent medical bills from bankrupting you. Don't underestimate the importance of insurance in your financial plan. Make sure you have the right coverage for your situation so you can protect yourself and your family from life's unexpected events. And there you have it, the top 8 income mistakes that could be slowing your financial growth. Whether it's neglecting to budget, procrastinating on retirement savings, or carrying high-interest debt, these mistakes can impact your wealth-building journey. But now that you know what to avoid, you can take action to improve your financial habits and start building the future you deserve. If you found this video helpful, don't forget to like, share with friends, and subscribe for more tips on achieving your financial goals. Remember, small changes today can lead to big financial rewards tomorrow. Thanks for watching, and I'll see you in the next video.